Thanks so much for tuning in to today's Talking Point. I'm your host, Neeraj Shah. Our guest today is Manishi Raychaudhuri. Needs no introduction. Manishi, great having you as always. Thanks for taking the time out.
Thanks for having me here, Neeraj. It's a pleasure.
The pleasure is entirely ours, and I think it's a pleasure for every Indian market participant, Manishi, as you said, the last few days, weeks, months, if you will, because the going has been rather splendid. So, how do you look at the argument of valuations versus momentum currently, Manishi?
Valuations in India have always been expensive. They have always been at a premium compared to the rest of the Asian markets. And the difference today is that that premium has reached possibly, about one standard deviation higher than the long-term average. But I would like to take a step back and look at some of the longer term or even medium term advantages that the Indian market currently has and which is now begun to be appreciated by the foreign institutional investor universe. First, India seems to be firing on all cylinders. I mean, historically, investors used to look at India as a consumption growth story, and particularly, what we have always called affluent consumption. That is now sort of transforming itself into an investment story also. We have seen government capex increase tremendously to about 25% of total government expenditure over the past 3 years. And that's beginning to have the usual multiplier effect on private capex. We have seen the various supply side measures, particularly, I would say, the PLI schemes, having a positive impact on certain sectors. The case of the smartphone manufacturing is well known, but it's having a rub off effect on many other sectors as well. If we add to that the currency stability that has come through on account of skyrocketing service exports and India's imports of cheap oil, then that actually, it becomes almost a heady concoction, a kind of a heady combination for the institutional investors, because it's difficult to find a combination of growth momentum, earnings momentum, stable currency, and a domestic flow cushion, which the market is being accorded over the past few years. It's kind of a rare combination that's working for India right now. It's kind of getting all stars aligned, which rarely happens in the equity market. And on top of that, try to think that in North Asian, the large North Asian markets in Asia, there's some kind of geopolitical issue or the other. In case of India, investors don't really have to care too much about the potential geopolitical tensions. So that's another risk factor that doesn't exist over there.
Very interesting, Manishi. So, I mean, I heard you say that this is rare. How long does typically such fanfare last? Part one. How
Mm.
for how long will investors be happy with a punchy valuations for a potent combination which you just described? And
Right.
when I speak to some of the other Asia Pacific strategists, they say India is there, but Japan is also out there. So on a relative
Right.
basis, even if not with the same potent combination, are there other markets that global investors are favoring more, or India is right up there?
If you look at Asia, and not just Asia ex Japan, but including Japan, there are actually possibly four markets that have done really well this year. Japan is the first example that comes to mind. It's up almost about 30%. You know, we also have had good performance from Korea and Taiwan, and finally, of course, India. Um, Now, the difference is that in case of India, Korea, and Taiwan, the currency has remained reasonably stable. And in case of India, possibly even more so. While in Japan, while the market in nominal terms is up 30%, the currency has depreciated 15%. So if one is a US dollar or a euro denominated investor, his returns are actually much lower than what it would appear on the surface. So I think again we come back to that original point that the flows that we are seeing from FIIs into India, not only are they enthused by the momentum in the domestic economy, but also by the stability in the currency. Many of the factors that I talked about in terms of economic momentum, the currency, investments going forward, these are structural, and possibly they would last for the foreseeable time horizon. The only question that you asked me, which actually, I think most investors, most analysts would be in a quandary to answer, is how long would the foreign institutional investors put up with these premium valuations? Because as we know, that flows tend to be fickle. So that is something we have to be mindful of, because there are alternatives emerging, in the same sectors in other markets which are a lot cheaper.
Manishi, the question that some of the domestic focused strategists bring out is that the domestic flows are so strong that,
Right.
unlike the previous times, valuations will not crash significantly, and therefore foreigners will have no choice but to buy Indian markets expensive, assuming that the domestic flow stays as is. So my question to you is,
Right.
when you meet your clients, do you advise them to not look for terribly cheap valuations because they may just not come?
Well, we actually, a couple of weeks ago, in our second half outlook for the Asia ex Japan markets, we upgraded
Mhm.
India to an overweight. We were neutral on India for about, I would say, 7 to 8 months, which did work for about 4 to 5 months. But the market started moving up since about late March or early April. And the kind of stocks that we have in the India silo of our Asia ex Japan model portfolio are mostly the frontline stocks, where the
Right.
valuation could be an issue, because they have already done well. But at the same time, when one looks at high quality, the stocks that have been generating excess return, ROE in excess of cost of capital for many years, the stocks that are generating free cash flows for many years and are forecast to do so, the companies that have pricing power, and are therefore able to withstand competition and, cost pressure, input cost pressure. Those are the companies we think would continue to trade at a premium valuation. There's no real alternative to them. And that, I think, is exactly the case with India. There exists a real good quality, an agglomeration, a good chunk of good quality stocks. And I think the foreign investors, while feeling a little uncomfortable about the premium valuations, are beginning to understand that.
Got it. So our clients, because your model portfolios will also have a large cap bent naturally because of liquidity, size, and safety per se. But are you as well, relative to what you normally would do, moving down the
Mhm.
market cap curve a bit or not really?
Yeah, no, that's an interesting question because we actually did so
Ah,
late last year. We did so in the consumer discretionary space. We did so in pharmaceuticals. I would say to some extent in the TMT space as well. But the bulk of our allocation to India is still focused on the large cap frontline names. So while we did move down the market cap curve a little to capture the relatively cheaper valuations, but I would say it's still the exception and not the rule.
so then is the portfolio growth based, Manishi, or is it value based currently? I mean, whatever value you can find. Though I must admit that in a lot of sectors which are not having growth visibility for the next 6 months, there probably can be an argument made for value. So how is your portfolio skewed currently?
So in case of India, we are still very much growth focused. So the I won't name stocks here, but the kind of
Yeah.
sectors that we have are really consumer discretionaries, and that includes autos, particularly four wheelers. We have healthcare, both pharmaceuticals and diagnostics. We also have the frontline private sector banks and insurance. And finally, and this is a non consensus call, we do have TMT, which includes both telecommunication conglomerates and pure plays, and a smattering of tech as well. And I say this is non consensus because both foreign institutions and domestic institutions have been underweight on the IT side for quite some time. Um, but we think that after a severe underperformance over the past 1 year, the new orders that we are seeing for the frontline companies should eventually stand this sector in good stead.
So, and when do these orders, for example, start showing up in the numbers, Manishi? And what's the kind of how do I say optimism that you share here? And is it very bottom up here, or is it across the bucket?
This is very bottom up, because we track the order flows into the Indian IT companies on a monthly basis. And it's really, a select few possibly who are benefiting from the momentum of new orders. It is not yet quite a sector wide phenomenon. So yeah, I think, it should begin to show up in the numbers, possibly late this year or early next year when the fourth quarter results begin to come through. But then again, to repeat myself, this is a very stock specific kind of phenomenon that we are seeing today.
Got it. Manishi, the other aspect is just trying to understand where you stand. So, by the way, okay, actually, just a repeat question here before I come to the next one. If indeed these quarterly numbers and maybe the guidance by some of the underperforming IT companies is weak, and if it takes down the sector numbers along with it, I would reckon you would then say that it actually makes some of the bets that you're taking a lot more attractive to put in sizable money to work.
Oh, absolutely. We are in general, our stock picking is bottom up. So if,
Right.
there are commentaries by, companies which takes down valuations in the entire sector, we would definitely be turning more positive on the companies that are fundamentally doing well.
But this is only restricted to large cap because there's some mid cap names, ER&D stocks, which have cited some fairly positive business traction, but the valuations aren't cheap. You avoiding that, or is that also forming a part of the portfolio?
As far as this particular sector is concerned, the IT services sector, our focus is relatively on the large cap frontline stocks.
Got it. Okay. Okay. Manishi, final couple of questions. There is this whole belief that if India is doing well relative to the world and the domestic focused sectors don't have a sales issue, they will probably have a benefit of input cost prices reducing over a period of the next 2 or 3 quarters because the global economy is not in ship shape. And therefore, the overarching bet, even from the current levels, should be there. I heard you mention autos. That's a prime example there, maybe, but some of the others too. Are you a proponent of this? And therefore, beyond autos, are there other pockets which kind of fit the billing?
Right. No, that's an interesting question because this commodity price moderation that we have seen, that's actually India is one of the beneficiaries, clear beneficiaries, not just on a macro front, because we are importers and it helps the current account deficit, it helps the currency. Also on a micro front, because many of the large frontline companies in consumer discretionaries, in industrials, in consumer staples, they are actually importers of these commodities. And, typically the commodity price deflation has a positive impact on margins with a time lag. And that time lag can be 2 quarters, it can be 3 quarters. So at some point of time, maybe in the last quarter of this year, that impact would begin to, it'll become visible to investors. And yes, I think consumer discretionaries and autos are one example. We are beginning to see that even in consumer staples. Even though, are not really, that sector is not really a great favorite of us. We don't have any consumer staples names in our Asian model portfolio. But, I think the commodity consumer sectors in general would benefit from this phenomenon.
Got it. Final question, and maybe you don't have a view here, but I'm still asking because that's the big development that happened last night. The GST on real money gaming, only a couple of listed names, but a lot of unlisted players, large investments out there. Maybe you don't have thoughts, but I'm asking you, do you have any thoughts here?
I saw that, and there are stocks that have reacted. I think, there are not too many listed stocks at this stage in India. There's possibly just one that, comes to my top of my mind recall. I think, ultimately, what should I say? Sector supportive policies, even in this sector, it might appear to be some kind of a luxury at this point of time, but, all these sectors have kind of knock-on effects in the ecosystem. If one looks at gaming in Asia, let's say in North Asia, there are very large companies here. India, in terms of having listed companies in this sector, are possibly 10 years behind. But that the kind of ecosystem that gets created if these companies are successful, that has immense implications for other sectors as well, because there's the kind of technological expertise and the technological skilled manpower that comes out from these companies. They have a very significant positive rub off on other areas.
Got it. Okay. Well, and that's I understand that point very well, Manishi. And I knew there are not too many, listed market implications, but still just thought we'll breach that topic. Thank you, though, for taking the time out today and giving us your thoughts. And of course, looking forward to having more often on the platform.
Absolutely. Thank you very much.
Yep. Thank you for your time. And viewers, thanks for tuning into this edition of The Talking Point.
How do you make the most of the India opportunity as an investor? For that answer, all roads lead to BKC in Mumbai on the 13th of July. 3 big money managers describe the size of this opportunity. 2 of the largest mutual fund CIOs then tell you about the mega trends that they're investing in. Will the current capex cycle be similar to the one between 2003 and 2008? We get that answer from Sanjeev Sharma of ABB in a conversation with veteran investor Madhusudan Kela. And then we rounded off with 2 of the most prominent investing names talking about how to make the large bets and make it really big. All of this and more at the Trident Hotel in BKC on the 13th of July. Catch the action live on BQ Prime.